a great Canada Day weekend. Sorry about the session for yesterday, and something happened that I have to change it to a virtual session today. So sorry about the inconvenience. I just wanted to. So what I would like to start working with is to have a quick chat with you about the midterm exam, and then I would like to then talk to you a little bit more about the chapter 15, and hopefully we have the time to start chapter 16 as well today. I'm just going to grab the course outline here. Now, the other thing I just want to ask you to remind you that the group project is due at the end of this week. So I wanted to have a chat with you about the group project as well, just to make sure everybody's okay, and go from there. Okay, so let's go through and talk a little bit about the group project first. I'm sorry, to talk a little bit about the midterm exam. I just want to hear from everyone about how you think about the midterm exam. Um, any feedback, any comments? Anybody?
Yeah, it's not easy.
Sorry, Evan?
It's not easy. It was not easy.
Okay, not easy in what sense?
It's I, the one there's not enough time, but also the content's not 100% what I prepared for. But it was still reasonable. Like I didn't feel like it was unfair. It was just not easy.
Hmm. Some challenging issues or whatever. Yeah.
Yeah.
Okay, that's great. Thank you. Thank you, Evan. Any other thoughts?
Yeah, I agree. I think the questions were fine. I just wish that there was like some extra time to finish all my thoughts.
Yeah. Okay, that's fair. Any other questions? Any other thoughts on this? Any other questions? I do recognize that the exam it may be a little bit long, but I just want to give you like an environment which you can kind of resembling the CPA CFE type of setting, in a sense that many times when you work on those exams, you don't really have a lot of time to think. You really have to look at the question, organize your thoughts, and start working through it. So time management is one of the very key things, and I find many of you are actually struggling with, which as I can tell from this exam. Actually, the contents for the exam questions are actually very similar to the ones we cover in the class. Actually, as a matter of fact, one of the questions, the leasing question, I think is very similar to the ones that I assigned you to work on. I think that is one of the question to do with the leasing. I think the lessor aspect is more to do with the manufacturing environment and things like that. But anyway, I think the questions are very, very similar to the questions that we go through. I have the sense that many of you, if you have worked through all the questions and so on, I still think that you have the issue of really trying to understand the concept based on the results I've seen. Many of you are really struggling with many of these concepts because the questions are on a very integrated basis now for this exam, and many of you are really having difficulties in addressing these issues and getting the right answer. So that's one thing I would like to ask everyone to please make sure that you do spend time and make sure you do fully understand the concept and not memorizing the calculations or whatever you have done, because it doesn't help you. As I mentioned to you, this is a very fundamental course for your CPA, CFE writing. And you really need to have that understanding and not really memorizing the answers, because then if you don't understand the concept, it's very difficult to apply the concept to the case scenarios or to the question that you need to work with. I don't want to drill into this, but I just wanted to mention also that, like before the exam, I think I do have office hours and so on. Some of you may or may not be able to attend because of a different timing constraints, but I don't hear from many of you regarding to the exam except for one or two students, and I make the assumption that all of you actually really quite understand your concept very well. I wanted to encourage you to please utilize these resources, because then we're all here trying to help you. if you don't come forward with a question, it's very difficult for us to gauge, what are the things you need more to help you to understand those concepts and be able to apply them. So that's one thing I'm actually quite concerned. So I think just to share with you about the result, this is actually one of the very, very worst marks that I've ever seen in this exam. The average score for this midterm exam is 38. This is the lowest I've ever seen since I've taught MGAC02 for quite some time. I do recognize that the exam may be a little bit, there's maybe a lot of contents to do, and there may be a lot of things to work out. But personally speaking, I'm actually a little bit disappointed with this grade, and I do recognize everything that everybody has to go through. Anyway, just to mitigate this, I'm offering everybody two things to consider. One thing is I do bell curve this exam out of 60, so I'm giving a very, very steep bell curve. So the average now is coming to be somewhere around 62. I would have hoped that this course is, you should have the average of somewhere in the 70s, but now I'm trying to bell curve it to around 60 out of 60 so that the average will now become 62. Now, after the bell curve, I think we do have the highest mark for this exam is 98. And then there's quite a few students who are now above 80, but I still want to make sure that you understand that the results are actually not very good. And please do try to work with me and work harder for your final exam to get through this course, because as I said, it's very fundamental and it's something that you need to know well for your CFE exam, or if you wanted to practice as a CPA professional into the future. Now, the other thing I'm going to offer all of you is that I do hope to see that you can have improvements for your final exam. So I'm also willing to shift half of the weighting for the midterm exam to the final. So if you do better in your final exam, even by 1 mark, I'm going to shift the weighting of the midterm exam to the final. The final exam currently is around 40, and I think the midterm is 25%. So that means that if you do better, your final exam would become 52.5%. So I hope that you are able to do better. Like last summer, we have a similar type issue, but I guess there is also a technical issue during the midterm exam. So most students did not do well, partially because of that reason. But many students turn around and they do really, really well in the final exam. So I hope that that's what's going to happen to this class as well. But that leads me to another thing that I want to talk to you a little bit more about, the way I'm teaching and the way I'm actually going through the materials, just to make sure if that's something that you're okay with, or is that something I need to change and consider enhancing? But just to wrap up the midterm exam, I will be posting the mark probably after class today, and so that you will be able to take a look at the mark and the feedback guide from the mark, so you can take a look at them. And then I would have office hours actually next year, so you can come and take a look at the solutions and so on. I might actually even post the solutions for you, so you can actually take a look at them at your leisure. So this way you can actually have an understanding about what's going on here. Any feedback, any comments, anything that you would like to share with me about the way I'm teaching? Are you okay with the way? I mean, we're using a lot of supplementary materials to enhance the concept. I don't know if that fits you. Is that something that you're feeling okay with? So I would like to also hear from you on this one here, because we still have a few more classes to go, and I do wanted to make sure that you are getting the best out of all this course, right? Anyone has any comments?
I just have a question.
Yeah.
Like, are you gonna change how you make the final based on the midterm mark, or are you gonna do the same thing?
What do you mean? Changing the what? Sorry, I didn't hear your question very well, Evan.
Oh, okay. So like, you know how for the midterm, you should told us to practice the supplementary questions.
Yeah.
Yeah. So like, for the final, are you gonna change that, or is it just the same thing?
Well, I think the supplementary question is always the good thing to start practicing, because those are giving you the fundamentals. Because every concept I go over, I usually try to come up with a supplementary question to supplement the concept, right? So that would be
Mm.
something that I think would really help you to understand the whole concept, hopefully. And then, as I encourage you to do in the midterm as well, that you should then go to YD Plus and pick up similar type questions to practice more, especially on the ones that you don't feel comfortable with. because practice would help you to get better understanding of the concept. But one thing I don't want to see is, because many students told me that they practice these supplementary questions so many times that they can even memorize the answer, whatever it might be, but that's not the right way of doing it. Because if you are just keep on practicing it and you remember the answer, that means you're not really understanding the concept. So when you are when the question get tweaked a little bit, or maybe the question is slightly different, then you would have a hard time comprehending those questions. So the key thing, as I said to you, you really have to make sure you fully understand why we are doing every single step in the journal entry, as an example. Like what are the implications? You really have to ask yourself on an ongoing basis, when I do the journal entry, what is the implication? What is it telling me in this, what is the outcome? Because that's really what I mean by the understanding, because you need to apply, right, ultimately these concepts into case facts to come to help to make some recommendation, right, in the future. I hope that answers the
Yeah.
question. Yeah.
Oh yeah, for sure. Yeah, because I'm just worried because
Yeah.
because the mid-different mark is so bad. I thought, oh no, things gonna change.
Yeah. But these things are fundamental, right? So you really have to make sure and go back to make sure fundamentals is okay. Any other comments? No? This is a very quiet class. I don't usually get a lot of comments and so on. So I'm encouraging you to speak up, and then definitely the more I can understand what your issues are, the more I can help you with. Because then if the student doesn't come forward and explain certain things, then it's hard for me to gauge, what are the areas you may have problems, or what are the areas that you need further enhancements. Okay, any other comments? I guess before we move on, because I don't want to keep on drilling on this. I think definitely until you look at your exam, you probably would not be able to comment more. Maybe we can touch base on this a little bit more when we meet in person next week to discuss this. But in the meantime, if you have any thoughts or anything that you would like to share with me, please send me an email, or we can arrange a time to chat as well. Is everybody okay? That's because the other thing is that, when we come at this virtual session, I don't see anybody, right? Because everybody turn off their camera. If you go for the CPA sessions, if you ever attended any session with CPA, it's mandatory that all the camera needs to be turned on. And because as an instructor, it's very, very difficult when I don't see the students and see the interaction of the students. So that's actually quite challenging for me. Anyway, I'm encouraging you to turn on a camera if you can. That would be helpful. But if it's okay, if you don't want to turn on the camera, that's okay as well. Anyway, so I'm going to move on to chapter 15 then, if you're okay. If you do have any feedback or any comments, I would like to hear it. So I'm encouraging you to do this. I think last week we did talk about chapter 15, and we did go over quite a few concepts, including the ones that talk about repurchase of shares. I would like to take up maybe handout question number 1 with you, but just go back to revisit some of the key concepts. When you repurchase, the company has the right to repurchase the share, but in Canada, you would have to, every time when you repurchase a share, you would have to terminate the share immediately. So a lot of times, when you are actually repurchasing the share, what you need to compare is the repurchasing price relative to the weighted average for the common share price that you have issued initially. The reason we needed to use the weighted average is because it would be very hard to trace back when those shares are actually issued initially. So that's the reason we wanted to use the weighted average as a benchmark. Now, if your repurchase price is actually lower than the is actually lower than the price that you actually are issued initially, then if that's the case, then that means that you will be you are actually getting some aspect of a surplus, because basically speaking, you're getting more money coming in, but you just take a little less money for those repurchase of shares. As a result of that, then you will have to take the difference into a contributor surplus. But if you're actually paying out more money to buy back the money that you have received earlier, then if that's the case, you would have a deficit. Then if that's the case, then what you need to do first is you need to make sure if I have any contributor surplus that is set up for those shares, for the same kind of shares in the past. If I do, then I need to offset against those contributor surplus first. And then I would then need to then if I don't have enough to cover, then I would have to take the remaining deficit into my retained earnings. The concept there is that as if the reason you put it to retained earnings is because it's similar to you giving out like a dividend to the shareholder, you're giving them more money, right? If that's the case. So that's one thing I would like you to go through. So if we can all take a look at the handout question number 1, if you can all turn to that question. So on the first question, we did talk about on January 1st of this year, they had 1 million common shares outstanding and at $5 million. So that's what they have. So the first 2 transactions, basically, they just issue shares, right? On February the 1st, they issued 250,000 shares at $8 per share. So what I would need to do, I would be debiting cash and crediting common shares, right? By $8 times 250,000. So I'm issuing $2 million worth of shares. So I would debit cash and crediting common shares. Everybody's okay with the first transaction? Then on April the 11th, it's the same thing. We also issue more shares. So we issue 475,000 shares at $9.50 a share. So in that case, it's fairly straightforward as well. I would be debiting again cash based on 950, right? I would multiply that by 475,000. So that's the number of shares that I've issued. And then I would credit common shares as well, because that's what I've issued. Then on July 22nd, they said they have repurchased and canceled 175,000 shares at $5.75 a share. So the first thing when you repurchase a share, you've got to work out what the weighted average common share is. But what you need to do is you have to take all the shares that have been issued, even including an opening balance. So in this case, my opening balance is I have the opening balance of $1 million shares of common shares, and then it's worth $5 million. And then I have, and then on February the 1st, because I've issued 250,000 shares, which is this transaction here, which is worth $2 million. And then in April the 15th, which is the April 11th, I actually have issued 475,000 shares, and the value of the shares is 4,512,500. So I add up all the shares that have been issued to date, plus all the value of those shares that's to date. So that gave me my weighted average common shares that was issued was $6.679, simply taking the total number of the value of the shares, which is 11.5 million, divided by 1,725,000 shares. So this gave me my weighted average common shares. Does everybody's okay? Do you have any questions? Okay, then because of the fact that we purchased the share at 575, 575 is actually lower than the weighted average common shares. So in this case, they would have a surplus. So you would debit the common shares. The common share would be debited based on the weighted average common share price, which is 6.6739 times 175,000. So that would be $1.167 million. And then my cash that I have to pay out for is based on 575, right? Times 175,000 shares. So I'm getting 1,006,250. So I have actually a contributor surplus of 161,885. I do have a surplus in this case because I'm paying less money to buy back the shares that I have issued earlier. Are you okay with this transaction? Do you have any questions? Then in August the 26th, August the 19th, they said they issued more shares. They issued 350,000 shares at $8.25 a share. So I would be taking, so I would debit the cash again. I would take $8.25, multiply that by 350,000. And then and then I would credit common shares. This is similar to the earlier ones that I did earlier. But then what they did is then October 26th, they do another repurchase and they cancel 325,000 shares at $9 a share. Because you're doing another repurchasing transaction, you have to come up with a weighted average. Now I have to go all the way back to the very beginning for the weighted average. So because these are the ones I've already done, so I can keep those in here. And then I need to I need to subtract the repurchase that I've done earlier, which I've repurchased 175,000 shares at $1,167,000, which is what I need to deduct from the pool. And then I issued another 350,000 shares. And that would be that, which I received $2,887,000. So that means that this is my total number of shares that's currently still I've issued. And this is the number of shares that I've issued. So that this now give me the repurchasing, the weighted average of 6.6942 per share. Now, because my amount I need to pay is $9, so I'm paying a lot more. So in that case, then I would have a deficit, right? So then the first thing I needed to do, because I have a deficit, I need to offset the all the contributor surplus I have in the account. In this case, I've created 161,685 earlier. So I need to debit that first. I need to use that up first. Then the remaining would come up from the retained earnings. Now remember, the weighted average common shares you'll be taking out is based on 6.6942 times 325,000, which gave me close to about 2.263 million. Then in that case, and with this offsetting to the contributor surplus, then the remaining that goes to the retained earnings would be the difference, right? Which is 499,936. Then on December 22nd, I issued 50,000 shares at $7.50. So I would take $7.50 times 50,000 shares. So I debit the cash and crediting the common shares, right, for that amount. Okay, does everybody have any questions for this problem? It's relatively straightforward on this question. Are you okay with this? Do you have any questions? If you have any questions, I would like to take a look at question number 2. Now, in question number 2, they basically give you the, I think as of January 1st, 2025, they have the equity section, which they give it to you. This is at the beginning of the year. Then they tell you dividends were last paid in 2022. I assume that's the number, right? Okay. Anyway, so maybe we can walk through it together here. So I guess they're asking you to record the journal entry that we needed to account for here. Okay. So the first thing is that they said, so the first thing they tell you there were no dividends arrears at that time. So the last one they did is 2022, is currently Jan 1st, 2025. So that means that they have 2 years, they have not paid out any dividends. So in the event that there is a cumulative preferred shareholders, you know that they would have 2 years in arrears, right? In this case that you need to account for. So in here, what we said is on Feb 1st, 2025, they sold 1,000 common shares at $65,000 cash. So I'm going to make the journal entry. Now I put down like 1,000 shares here because that's something that I wanted to account for later in the event I have repurchase of shares. So that's why it's better to put all the information that you have here so that you can pick up the information directly from the journal entries. Now they tell you that, because I issued 1,000 shares, that means I'll be debiting cash for 65,000, right? And I'll be crediting common shares for 65,000. That's what I would do. And then they also talked to you that on March the 1st, they issued a 5% stock dividend on the common shares. Now, first of all, you need to figure out when you do stock dividend, you've got to figure out how many common shares they have on hand, and then you would take the 5%. Now, so in the very beginning, if we take a look at the common shares that are outstanding, they tell you that they have 20,000 issued. If you look at the table that's underneath that's immediately after the question two, you will find that they have common shares, which is issued for 20,000. And then they issued another 1,000 shares here. So that means they have a total of 21,000. 5% of this is worth 1,050 shares. And then they did tell you that they're running at the fair market value is issued at $65. As I mentioned to you, stock dividend are usually declared, the value is declared on the market price as of the date of the declaration. So if that's the case, then that's what they have. So they're based on $65, right? So you would multiply that by $65. So this is the value of the stock dividend that you would need to account for. So the journal entry that you needed to do is you'll be debiting the retained earnings for 65,000 for 68,250, and then you'll be crediting the common shares, which is the 68,250. Because the reason you're debiting retained earnings because it's a form of stock dividend. So that dividend usually coming out from the retained earnings. That's what you do because this is common. It's a stock dividend, so that's why you'll be crediting the common shares here. Anybody has any questions here? Okay, then if you don't have any question, let's move on. Then they said April 1st, they declare $50,000 in cash dividend payable on April the 15th, 2025. So first of all, you got to figure out what's in arrears because those things have to be paid out first. In this case, we do have cumulative preferred shareholders on Class A. Okay, and then the dividend rate is $3, and they have 2,000 shares that are issued. So that means that they have $6,000 per year, right? And then you have to take 2 years because the dividend arrears is basically from 2024, 2020, I'm sorry, 2023, 2024, right? Those are the 2 years that's in arrears. And then based on every year, the entitlement for these cumulative preferred shareholders is based on 3 times 2,000, that's 6,000. So that means they would have 12,000 dividend arrears that you need to work with. Then you have to deal with the Class A preferred shares for the current year, which is $3 times 2,000, which is another 6,000. This should be 12,000. And then Class B, because those are the preferred shares, they will be getting entitlement for the preferred shares as well. And that would be 5,000 each, and each one is entitled to, well, those are based on dollars, right? $5 times $5, right? That's what you need to do. So we take 5,000 shares times $5. And then the remaining will be common shares. That's what they need to do now because they've issued out the total of they said they issue $50,000 in total. So what's remaining is basically whatever that's left here. So that would be $7,000, I believe. So that
Professor,
should be, sorry?
I think the Class A is 6,000, not 5,000.
Oh, that's it. The second one is 6,000. Sorry. Thank you. So that should be 50,000 minus 12 minus 6 minus the 25,000. So you should have 7,000 there. That's right. Thank you so much. Yeah. So this is what we should be getting. So your journal entry needs to be taking a look at the dividends payable. You'll be debiting retained earnings for 50,000, and you'll be crediting these dividends payable to Class A shares is 18. Class B shares for the preferred is actually 25,000, and then the common shareholders would be 7,000. So that's the journal entry you needed to make. Is everybody okay with this? Do you have any questions? Okay, if you have any questions, we can move on to the next topic here. Then they said on April the 15th, they paid the dividends, right? So they paid the dividends. That means that these ones they have paid now. So you would debit all these payables and credit in cash for 50,000, right? Then on May 1st, they said they repurchase and cancel 1,000 of Class B preferred shares. The Class B preferred shares, there's no new issue. It's just strictly what the value they have over there. So it's basically $500,000 divided by 5,000. So that means it's $100 each. And then because they have any other transaction except the initial one, they said they actually paid out $110. So they actually pay extra, right? For this one, that means they would have a deficit, right? In this case. So in this case, I'll be taking out $100. The preferred shares that was issued initially was based on $100. So I would take $100 times 1,000 shares. And then the cash that I actually paid out is 110. So the rest would go against your, that's not right. Okay, so they would have they would have to take off 10,000 from the contributor surplus because they do have contributor surplus from the repurchase of Class B shares, which is 20,000, right? So you have more than enough to cover this deficit, this deficit here. Is everybody okay? You know where I would benchmark it? If you go take a look at the table they provided you, they actually have contributor surplus for repurchase and cancellation of Class B shares. As I mentioned to you, these contributor surplus are dedicated, they're designed specifically for the type of shares that we deal with. So in the future, if you would have to offset against these contributor surplus because you have a deficit situation, then it has to be able to only offset by the same type of shares, right? That's the key question that we were talking about earlier. Then on June 1st, they said they spent 75,000 to repurchase 1,000 common shares. Now, so we have to work out what the weighted average common shares is. In the very beginning, the common shares is basically 20,000 for $1.3 million. And then on February 1st, they have repurchased some shares, which is 1,000. At $65,000. And then the stock dividend, which is 1,000, which is what we have here. Sorry, which is 1,000, the stock dividend. Let's go back here, 68,250, right? They have 1050 actually. So 1050. So they have, this is against my medical. So that would be around $64 per unit. I think, is everybody okay? I think I may have a mistake here. 14, 68,250. This number should tie back to what we have here, right? Okay. So that means that your weighted average price is that I need to debit common shares for 65,000. The cash I need to pay out. They're paying out at $75,000, right? So that means that they would have $10,000, which is going against their surplus, I guess. Are you okay? Do you have any questions?
Professor.
Yeah,
So if there was no contributed surplus in the question, like if it was zero, it would be under retained earnings, right?
that's right.
Okay, is there ever an option where the cash paid is less than the shares?
Yes, if that's less, then you would need to take the difference to contributor surplus. You create a contributor surplus account. If they
Oh,
don't,
okay.
yeah,
Okay.
okay, yeah. And then the last one is they said they declare and distribute two for one stock split. You don't really have to make a journal entry. You do have to make a memo entry to indicate what is the amount of shares that they would come up with here. So they do come up with the shares of 21,050, which is what I have here. But then they need to subtract the 1,000 shares that they have actually. So to start with, we have 22,050 before the repurchase of shares. Now I've repurchased 1,000 shares. So I need to take 22,050 minus the 1,000. So I only have 21,050 left in the number of shares because it's 2-to-1 stock split. My number of shares has now gone up to 42,100. Is that okay? Do you have any questions? Okay, I assume you're okay. So let's take a look at question number 3. So in question number 3, they give you that on Jan 2nd, 2025, Mabel was incorporated the Province of Ontario. It was authorized to issue a limited amount of no par value shares and the 10,000 common shares of no par, and it's cumulative as well. Anyway, they give you like a bunch of journal transaction here. So the first thing they said to you is that they accepted subscription for 40,000 common shares, and they paid down payment of. So that means that they would have issued the shares of 480,000, but then they only receive $150,000 in cash. So you would debit cash for $120,000, right? That's the first thing you needed to do. They receive $150,000 cash. And the common shares subscribed is going to be 480,000 because it's $12 times 440,000. So the remaining will go against your subscription receivable, right? Is that okay? Do you have any questions?
A quick question.
Yeah.
Can I split that into two accounts, like two entries?
Can you make it? Sorry, what is the question again?
Can I split that into two entries? Because I put
You could,
two.
yeah. Yeah,
Okay.
you can. I hope I didn't cut you off, but you can actually do it two different entries if you like.
Yeah,
Okay.
that's what I did. So yeah.
Yeah, that's good. No problem. So then on the Jan 30th, they actually have issue 4,000 shares in exchange for the asset. Now, normally speaking, this is like one of your what do you call it? Like the uh, oh, I forgot the term, but um, this is not a monetary transaction, right? Because they issue shares to actually buy the product. And in this case, they did give you the fair value of the machine, which is at 35,000. Factory fair market value is 110. Land value is 295, but they didn't tell you what the value of the shares are. So in this case, you can only use the fair value of the assets that you are receiving as the base. So in this case, you will be debiting the machinery for 35,000 and your factory for 110,000 and your land for 295,000. And then so your total number of shares that you needed to account for, it's a total of those three, right? Which is 440,000. Okay. Then they said the machinery with a fair market value of 50 was donated. When you have a donation by the company, we usually take the credit side to the contributed surplus for the donated assets. So in this case, because they're donated, so you would be debiting machinery for 55,000. And you would credit for the, sorry, I put it in the wrong place. uh, 55,000, right? Is that okay? Do you have any question? And then on April the 25th, they said they collected the balance of the subscription receivable. So basically, they collected this balance, so with debit cash and crediting the subscription receivable of 330,000. And then we have to account for the, then they wanted to purchase, they purchased 2,200 common shares at $18 per share. The shares would be tied, meaning that you would need to offset this against the repurchase of shares. So they bought 2,200 times $18. Oh, I'm sorry. The previous question, now that we have collected the subscription receivable, we also have to issue the shares now. So the shares is basically issued at 480,000. So I need to debit these common shares subscribed, crediting the common shares. Okay, so in this case here, I would be debiting let me see here. So they're basically speaking that for June 20th, they purchased $2,200 at $18 per share. So that means this is the cash you'll be getting is 18 times. Okay, so that's one thing that you need to account for. But then on the other hand, they have to figure out what is the weighted average common shares is. So if you take a look at Jan 8th transaction here. Okay, so take a look at this. Okay, so let me see here. Okay, number Jan 8 transaction. So this is really what we had. This is the only transaction we can only account for this because there's no other transaction that affects your common share value. The common share value in this case is based on $12 a share, right? So that means that you would be debiting, right? Common shares because the weighted average price is basically at $12 per share. So you'd be taking $12 times 200,000, 2,200. Then you actually have in this case, you actually have a deficit as well, right? So you'll be taking a look at the difference. Is it okay? And finally, they have a profit. They do 198,000. So debit. And then retained earnings, I'll be crediting $198,000, right? The 198,000 is really the income they generated. So you just debit income summary and crediting retained earnings. Because those are the income they generate, and you need to close it off to the balance sheet. And then the next one is we will be debiting the retained earnings because they said dividends are payable on Jan 1st to the shareholders of record of Jan 5th, 2024. So you have to take a look at how many shares do they have on hand. So you'll be taking, they have 37,800 shares on hand. Now, so basically what they have is at the beginning, they have 40,000 shares. That's what they have in the very beginning. And then because that's what they do for the subscription, and then they repurchase back 1,000 shares. So that's why they have the 2,200, which is what they have buyback. So that's why they have 37,800 shares left, and each one is giving out $1 dividend. So this is the amount that they will be entitled to. Is that okay? Do we have any questions?
Question.
Chapter 15 is definitely relatively straightforward, so I'm not going
Uh-huh.
to spend too much time on it, but I hope that you are okay. You understand what we are talking about in chapter 18, in chapter 15.
Yeah, Professor.
Yeah,
Do we pay out the preferred dividends, the preferred shares here, or do we ignore that?
we ignore that because then I think the question says that technically speaking, because they only talk about common shares here, right? So that's why you only account for the transaction for common shares. Normally speaking, they should be at the same time, I would think.
Hmm.
But for this
Oh, so
one,
okay.
because they only tell you, but they tell you specifically only for common shares, right?
Okay, so usually if we should pay the preferred share first, then the common.
That's right.
But in this specific case, it's only common.
That's right, because that's what they said they pay.
Oh, I see. Okay, thank you.
Yeah, but then generally speaking, you're right. I think that when you're just doing a big pool of cash dividend or something, you need to pay out the preferred shareholders first. That's
Hmm.
what you need to do. Okay, is everybody okay? All right. I wanted to very briefly touch on chapter 16. I don't want to go into too much. I know you have a lot to take back. And being today, everybody's anxious to probably get back their marks as well for the exam. I do wanted to spend a few minutes just talking about maybe one or two critical concepts for chapter 16, because there's quite a few concepts and it might take up a class to work it out. Now, next week, Wednesday, we do have an edit class as well. So I just want to make sure that you know. And then in the edit class, I would like to catch up with the materials and also go over maybe the leasing on the SB side as well. So those are the two things I would like to do. So basically speaking, what we would be what we needed to do is talk about hybrid instruments. Like in chapter 16, there are only three key topics I'm going to cover. One is to do with a hybrid instrument, one is to do with stock options, and one is to do with the share appreciation rights. So those are the three things I'll be covering for chapter 16. So now, first of all, talk about hybrid instrument. Now, hybrid instrument is actually quite common, meaning that you are dealing with a financial instrument that has both the equity and the liability component to it. The very common one that we always talk about is convertible bond, because convertible bond has both elements in the instrument. As an example, because it's still a bond, your interest payment is like your debt commitment, which you would have to pay out on a regular basis as a commitment. But then at the end of the day, you can settle the bonds based on shares that you issued instead of paying out cash. So if that's the case, that would trigger a equity instrument. Now, under IFRS, what's required to do is that then before you go into the transaction, IFRS requires you that you need to break up the element between the debt and equity component. You need to record both of them in the initial transition. That's one thing you need to do. Now, how do you actually break down and figure out which component is that, which component is equity? What you need to do is you would need to take a look at the similar instrument in the market that has no conversion feature, that only has the regular bonds feature, but it's exactly the same instrument, then you can use that as a benchmark to figure out what the debt component is. And then the remaining proceeds that you're receiving, then is to do with the equity component for the conversion feature. That's what you need to do. That's one thing. Now under ASPE, you could actually do it this way. You can actually break down the debt you have, because under IFRS you must break down the debt and equity component upfront. But under ASPE you can choose that as an option, but then you can also do the whole instrument as a debt instrument, and then you can then deal with it if it converts later on as well. So that's why it's a little bit different in the treatment. So for the sake of this question, I would be focusing on basically giving you like an understanding about how hybrid instruments are working under IFRS, which is also acceptable under ASPE as well. So if we take a look at, so maybe the best thing to do is to go over a question with you. You can click over question number 3. I'm sorry, question number 1 under your chapter 16. They said on December 31st, 2025, ABC issues 5 million, 50 million, 5%, 25 convertible bonds for the total proceeds of 39 million. So you know that this is being issued at a discount, right? Because it's less than the face value. Interest payment is only paid once a year, which is December 31st. Then they tell you that they want to record the transaction initially based on the assumption that on a similar instrument in the market, the risk-rated non-convertible debt is actually 7%. Now, this instrument, right? The stated interest rate is 5%, but they did not really give you what the interest rate is in that case. I mean, they only gave you the stated interest rate, but then they did give you that if on a standalone basis, if the instrument is non-convertible, they're running at 7%. And that's what you need to benchmark. And that's what you need to do to come up with the calculation of the present value of the bonds payable account. So let's do that first. So the first thing we need to do is take a look at the present value of the debt component, which is based on the standalone with no conversion feature. So we take the present value of $50 million n equals to 25 and I equals to 7%. And then I would take a look at the interest, which is 50 million times the 5%, which is 2.5 million. And then you would take that times then I equals to 7 and equals to 25. So this would give me if I would only have been a debt instrument standalone, this would have been my proceeds that I would be receiving. But currently your proceeds is 39 million. So I mean the difference between this and the 39 million is the equity component. So how do I record the entry? I'm recording $39 million here because that's what I receive. And then the bonds payable is based on 38,346,417. And then the remaining will be based on the equity component of this transaction. Now take a look at the description of the entry. We call it contributor surplus, right? Conversion right, because it's due to do with the issuing of shares. So that's why we put the contributor surplus, but just to do with the conversion rights. So this is what the equity component is. Do we understand this transaction here? Okay. So in this case here, the interest expense is based on, then I still need to account for the ongoing transaction because this is something still I needed to account for. So on an ongoing transaction, right, the interest expense is based on the carrying value, which is 38,346.47 times. This is exactly what we did in chapter 14. So I'm going to take a look at that multiplied by the 7%. So that's actually my interest expense. The cash I paid out is 2.5 million, right? And this is issuing as a discount. So as I amortize it, I need to amortize it and then increasing the bonds payable to bring it back to about the $50 million. That's what we have originally. So I need to take the difference of those two. So the journal entry that you did every month, there's really no difference. Okay, so the carrying value of the bonds then at the end of that period would be based on 38,346,417. And then I would need to add 184,249 because it's a discount. So as time goes by, my face value would actually start to go up until I reach to 50 million. So this is what I needed to account for. And then because the conversion happened, if you take a look at B, the conversion does not happen until December 31st, 2025. So that means that I needed that, which is basically 2 years later. So I need to account for the interest to take my carrying value up to the end when the conversion actually happened. So in this case here, that I would actually take the interest expense the second year, I would do the same thing. My carrying value is 38,350, 530,666. So I would take that and multiply by the 7%. Okay, and then my cash I paid out is 2.5 million. So my amortization is the difference, right? So that's then my carrying value of the bonds payable is going to be 38,530,666 plus 197,147. Now remember that they said to you that 45% of the bonds is being converted. So that means this 45 of this amount is going to be converted into common shares. So that means that this would form part of the value of the common shares, right? So you would take you would reduce that amount by 45%, and that value would go into your bonds payable account. But then on the other hand, you also have to take a look at 45% of the equity component, right? And that would also form part of your equity account. So that means my total common shares that I would be doing for this conversion is a combination of these two accounts. Now remember, I'm not paying any cash out. I'm only paying them out based on the actually based on the value that the portion that I'm still outstanding for the bonds payable, and then the equity component for the conversion to come up with the total value that I need to account for the for the shares. Does everybody understand the concept? Are you okay with the hybrid instrument? Everybody's okay? I wanted to just jump to question number 3 because that's an easier question to deal with. That's to do with convertible preferred shares. Now, in that case, it's a bit easier because you are just converting common share and equity instrument to common and the equity instrument. So in that case, it's actually quite straightforward. So what they're saying to you is on June 18th, 2025, Metro Inc. issued for $102 per share, $30,000 no par value, $4 cumulative. This is a cumulative preferred shares that they have. So they can convert into 5 different common shares at the option of the preferred shareholder. So at the time of the share value, similar non-convertible preferred share was selling $100. This is actually irrelevant in this case. And on August the 17th, 20, all of the shares were converted into common shares. The market value again is irrelevant. That's just the reference point that you needed to account for. So in this case here, what I would do is I would actually take a look at. So because in the beginning, when I issued the convertible preferred shares, it's based on $102 per share at 30,000 shares. So I would take 102 times 30,000 shares, right? That's what I would be debiting. So I debit cash for that amount, and I would credit the preferred shares for that amount. That's what I would be doing. And then the other thing, then they declare a dividend, right? They declare dividend in 2026. The dividend rate is $4 per unit. So you would be taking $4 times 30,000 shares, right? And then at the end, they would just be conversion preferred shares. So basically, you're just converting from one to the other. So you basically can just take the 3.6 million this one here, and then just take it and put it into your common share value. So this is really quite straightforward in that case. Everybody's okay with this? Do you have any questions? Okay. I'm just going to go through one more question, and then I would wrap up the class today in that regard. Now, definitely, when we talk about hybrid instrument, we talk about that equity component because we have the conversion rights, which is the equity component. Many times when the company are issuing like bonds and different things, they would also give somebody what they call the convertible warrant. Now, when they receive these warrants, the warrants can be traded on its own. So you do have a fair market value on the warrants on its own. But the other thing is that then the warrants allow the investor to actually convert them into common shares as well. So that's what the warrants is for. So warrants are giving you the rights to convert them into common shares. So many times that would become also an equity instrument, right? So in a case where you have the conversion rights or the bond of the warrants, you actually have two different type of conversion rights. One is to do with the regular conversion, just converting from bonds to shares, and the other one is that because of these detachable warrants, these detachable warrants also have the conversion rights to convert them from the warrants into the shares. And that's one thing you need to do. So now, at the time of issuance under IFRS, if you do have warrants and you do have the conversion rights, you have to make sure that you have to break down all these different equity components together with the debt component. This is a very complex type of hybrid instrument that you need to work with. So like in this case, they said on September 30th, they issued 2 million, 8%, 10-year convertible bond, basically maturing on September 30th, 2035. That's a 10-year bond. They have semi-annual interest payments. That's what they do, March 31st and then September 30th. Each 1,000 bond can be converted into 80 non-par value common shares. So you can have a conversion rights that way. And then the other one is that every 1,000 bond is also including a 20 detachable common stock warrants. That's what they have. And then they also said to you that the immediately after issuance, the bonds are actually traded at $4. So as I said, you need to figure out what is the fair market value of these detachable warrants at the time when you are arranging for this hybrid instrument, and so that you can actually segregate the value out of it. Immediately after issuance, the warrants traded at $4, and they said the gross proceeds on the issuance is $2,555,000. So that means that as you're recording this transaction based on the $2,555,000, you need to break it down into the debt component, which is the bonds payable. You need to break it down into the conversion rights, which is the equity, and you also need to figure out how much is the warrants worth, because that's also the equity instrument. You need to break it down. Then they talk to you about a conversion. They said half of the warrant holders actually exercise one half the warrants, and then the shares were traded at $44, which is not quite relevant at this point. So what you needed to do first of all they said that they did tell you that they asked you to allocate the $2,555,000. They did tell you that if they do not have the warrants and the conversion, the bond is expected to use 6% annually. So basically speaking, on a standalone basis, again, that's the first thing you want to figure out, what is the carrying value of this bond at the time of issuance. Now remember, you received 2,555,000, but this is made up of three different components, right? The first component is the bonds payable standalone. So you do the present value calculation here. And if you do the calculation, it's going to give you 2,297,549. Now, how do I did it? You take the present value of the 2 million times the 4. This is the annuity, which is the interest payment, which is $80,000 per year, per 6 months actually. And then I equals to 3%. That's only half of, because you have 20 periods. So every period you only have 3%. And then the present value of 2 million, N equals to 20, I equals to 3%. This is what you get the bond, the debt component of this particular instrument. Now the stock warrant, because every $1,000 bond you can convert into 20 stock warrants, and the fair market value is actually $4. So you can actually take 2 million divided by 1,000 times 20. That give you the number of stock warrants that actually outstanding, which is 40,000. that will be worth $160,000 because they tell you immediately after the issuance, the fair market value is traded at $4. Stock warrant usually the warrants, right? Convertible warrants usually have their own fair market value, and this is what I'm saying. So you can actually come up with that value. Then the remaining portion, then in this case, would become to the conversion rights that we talked about earlier. So you'll be the difference of 2,555,000 minus the 2297549 and minus the 160,000. That's what we are having here. So that's one thing you needed to make sure you account for. So my journal entry would be debiting cash because that's how much I receive when I issue this instrument, but I'm breaking it down to 3 different components. The first one is to do with debt. Just 2,297,549. I would credit the bonds payable for this amount. And then I would credit the bond, the stock warrants, which is $160,000. I would credit the conversion rights to be 597,451. Now the account that you need to go to for both the warrants and conversion rights, they're all going into the contributor surplus account. Again, these are all dedicated to those accounts, so you have to make sure that you only put it to that account for this purpose. Then on December 31st, 2025, which is the period that they ask you to record the journal entry for the whole year of 2025. So at the end of 2025, you would need to come up with the journal entry for the interest payment, okay? Because the period they have is September 30th and March 31st. So basically speaking, you would have to account for because this is the year end, so you have to accrue for the interest in this case. So I would take 2297, which is my carrying value of the bond, multiplied by 3% because it's going from basically October to December, right? Because the interest payment period is September 30th, and then you will go to March 31st. So that means it's a 6-month period. So from October to December is 3 months. You need to accrue the interest for 3 months because that's the year end. So you need to take 2297549 times the 3%, but you only divide it by 2 because it's only for the 3 months to the year end. So that's basically 34,463. And then the interest payment you would credit to the payable. It's based on the 80,000, right, divided by 2 as well, because you're only accruing for the 3 months. So that means that the difference would go into my bonds payable, right? This one is put in the wrong place. Okay, so the bonds payable is 365,537, right? That's what we should be having. Sorry, did I put it? This is 40,000. Is that okay? So that now this is issued at a premium, right? Because we have it's a $2 million bond, but then we're issuing a 2x55. So that means it's a premium. So that means I need to bring down the bonds payable as I amortize the interest payment. So in that case, my carrying value now at the end of the year is basically speaking is 2292012 is basically taking the carrying value, subtracting the amortization, which is giving me that number. Then they ask you to account for the stock warrants that has been exercising. So at the end of the time when the stock warrants are exercising, they did tell you the exercise price is $20 each. So that's what you're receiving. So you're only exercising half of the warrants, and you have 40,000 warrants as we calculated here. So that means you'll be receiving the 40,000 divided by 2, right, times the $20. That's how much you're receiving in cash. So you're receiving $400,000 cash. That actually would go from value of the common shares, and then you also have to take out half of the contributor surplus that you put into the stock warrants. That means you have to take out 80,000 from there as well. So that means your total common share value for what I convert the stock warrants is worth 480,000. Now that conversion price, that price that you need to pay when you actually exercise the warrant is given to you in the question because they said the exercise price is $20. Any questions about this problem? It's a little bit more complicated, but the concept is similar, right? Are you okay? I went through this relatively quickly, but so please take a look at them if you have any questions. Next week, I would like to start taking a look at the remaining part of this, chapter 16, and then I would like to start talking about chapter 18, which is talk about deferred income tax as well. And then next week's makeup class, I would be continuing on the deferred income tax. Hopefully we can finish that chapter, and then we'll be discussing also the SB on the leasing thing as well. Is that okay? Any other questions? Okay, if not, then if you then have a wonderful week. I'm going to post the marks for the final week of the midterm exam shortly. If you do have any questions, please let me know. And then sometime this week, I may be posting you with the solutions as well, so that you can take a look at them and try to see what how things are. Okay, thank you so much, everyone. I'll talk to you later. Thank you. Bye-bye.
Thank you.
Yeah, see you next week.
Thank you. See you next week. Thank you.